People look at the markets and the incredible month the market's having right now, even in the face of lots of bad news, concerns about the election, the push back and forth, the COVID cases continuing to climb. It's confounded a lot of people, but you say there's good reason for that. Why don't you list those?
Yeah, I mean, I think, Becky, what people don't really consider as much is growth going into next year, assuming you've got vaccine development, is going to be pretty good. I think you're going to see GDP over 5% next year. But then you take that into account with the amount of liquidity that's come into the system. You've talked about it on the show. There is an extraordinary amount of liquidity, cash that can go into the markets. And then you think about what the alternative is in the financing markets. You think about where treasuries are, but think about where companies are financing themselves in the debt markets, less than 1% in many cases. The earnings yield of the S&P 500, if you look at next 12 months earnings, is still over 4%. The free cash flow yield, which is a metric I tend to look at more than earnings, a free cash flow yield going into next year is over 4%. Gosh, if I can get equity upside versus buying the 10-year note or the 5-year note or where some of the fixed income is, it's going to make a lot of sense. And the amount of cash that can go in is extraordinary.
Part of that is there is no alternative sort of argument that we've been hearing for a very long time. You just think equities are a better place to be.
So there is no alternative. It's a really big deal. I mean, people have to put money to work, particularly when you think about it. I think people have missed the savings rate has exploded higher. The liquidity of the markets has exploded higher. We look at the cash that's on the sidelines. It's grown over $2 trillion over the last 12 months or so. So there's an incredible amount that can go in. However, there's something that is much more powerful than there is no other alternative, and that is when companies finance themselves at the levels they're financing at, when interest rates are where they are, that is a direct injection of value into companies. And so why have companies borrowed? Why have they built cash on balance sheet? What you're going to see in the next year is M&A. You're going to see CapEx. You're going to see spending in R&D. And you've created a dynamic where companies are sitting today that they're flush with cash, particularly big investment grade companies. They'll utilize that cash and the ability for the economy to grow and for companies' equity valuations to grow. By the way, some of that cash is going to get dividended out as well, depending on the sector, financials, et cetera. So anyway, I think it's well beyond there is no other alternative. It is a direct injection of enterprise value into companies when you keep rates this low. And by the way, keep them this low for the next couple of years, presumably.
But Rick, a big part of the reason that companies are sitting on so much cash right now is because they're afraid. They don't know what's going to happen next. They raised a lot of this money with the expectation that, hey, we'll be able to weather any downturn that gets through that. But you think as the picture starts to look better, as vaccines get out there, as there's less concern about coronavirus, as we kind of make the transition to a new administration, that all that uncertainty dies down, and then they'll redeploy it in R&D and M&A and all these other places?
So, I mean, first of all, it's iterative. And, we still have some uncertainties like you've chronicled starting last night with the Treasury and the Fed. So that's out there. You've still got the election dynamics that's not settled. You've got the COVID dynamics. So it depends on the industry, depends on the company. But I think as you get into next year, a lot of those uncertainties start to mollify and that money will get to work. By the way, it depends on the industry. I mean, it's, department stores, cruise lines, airlines, tougher. And do you hoard cash for a period of time or raise more cash? I think so. But boy, the other industries where the free cash flow generation has been surprisingly good, I think that money can be spent. And by the way, the big thing coming out of recessions, Becky, is companies improve their productivity. And what you do is you try and create synergies. You do M&A to try and get your cost structure down. And I think you'll see more of that.
Shepard Smith here. Thanks for watching CNBC on YouTube.